This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Prepayments and accruals. Remember, these are probably not going to be the most material items in any set of financial statements, but we need to look at them anyway to try and make the financial statements as accurate as worthwhile. What are the methods generally used? And the first thing to do is to look at last year's file, really last year's audit file, because many accruals and prepayments are going to be recurring. They are because you pay maybe your insurance always at the beginning of April, and that's going to last you all the way through to the next 31st of March. And that's a regular payment, a regular pattern, if you like. So you're always going to have 3 months that would be a prepayment. The January, February, March part of that is really to do with next year. Similarly, rents probably always paid in particular dates and so on, and there's a regular pattern to those. Wages and salaries often paid a week in arrears or maybe a month in arrears. And again, because the year end is always going to be at the same date, they will fall into particular patterns. So the chances are whatever's an accrual and prepayment last year may well be an accrual and prepayment this year, and all we have to do is to find the relevant invoice and work out the amount. For accruals, and I suppose we are slightly more concerned about missing accruals, missing liabilities, overstating profit and understating profit. For accruals, it's absolutely normal to look at payments made after the year end. We're not talking here particularly about payments being made to suppliers who are going to be on the payables ledger. We kind of ordered them separately. We're on the lookout here for perhaps a repairs and maintenance bill. If you remember earlier I said how we're going to pick up the fact that in the 15th of December we had some maybe quite expensive roof repairs done, or repairs to a piece of machinery or to a car, and the invoice perhaps doesn't come in until after year end, has never been entered into the payables ledger at all until after year end. So if we look at payments, scrutinized payments made after year end, particularly payments going to accounts like repairs and maintenance, then we may pick up payments made then which really relate to the previous financial year. Invoices paid in the last few months are likely to give rise to the most substantial prepayments. So if you had an insurance premium which was paid in, let's say, November, the chances are that maybe 10 months of that is a prepayment and only 2 months is to be charged to this year's profit. So again, scrutinize these to see if there's any of these which need to be split in some way between 2 financial years. Analytical procedures. Analytical procedures looking at expenses. If an expense suddenly goes up or down compared to last year, is it because maybe we've left out an accrual or a prepayment in that amount? Of course, some expenses are naturally volatile. Repairs and maintenance often goes up and down quite a lot, simply depending on what's gone wrong, what piece of machinery has broken down. But if any expense goes up and down markedly, it's worth looking to see why has that happened. Can we get a proper explanation for that variation from last year or from budget? And finally, there's something which is called a letter of representation, which we haven't talked about yet. We talked earlier about a management letter. This is a letter which goes from the auditors to management, pointing out areas of weakness in the system of internal control. This is quite different. This is a letter which is really in a way dictated. The wording is set out by the auditors, but it is written on the company note paper and is written from the directors to the auditors. And it is making representations such as all liabilities that we know about have been included. We will come on and see later more detail about this letter of representation. Of course, it's quite weak evidence. It's entirely internal evidence. It's not really documentation other than it's self-documenting, but we're not looking at any third-party documentation. that is really being produced by the directors. The idea is it gets directors really to focus their attention by writing a letter and signing a letter saying, yes, as far as we know, all liabilities have been included in the financial statements. No auditor will sign the set of accounts, will sign the audit report unless a letter of representation is obtained. It is regarded as an essential piece of evidence, sufficient appropriate evidence for the completion of the audit.